Timothy Moe, Chief Asia Pacific Equity Strategist at Goldman Sachs, joins us right now on the show. Tim, great having you. Thank you so much for taking the time out. Good morning to you.
Well, thank you so much for having me. It's always a pleasure to be on.
Yep, the pleasure is ours, Tim. Now, Tim, looking forward to this conversation because the global situation, as always, is anything but quiet. And we read your report, which has dwelt a bit on this. I want to take some leaves out of what you've written and, of course, of all the recent developments that have happened, right? Now, in one of the notes you had mentioned, in the note you had mentioned that looking ahead, many investors are concerned that markets have become complacent, particularly regarding the potential for a rebound in trade tensions. And now we've had some sound bites coming out of London which say that maybe, just maybe, US and China have reached some kind of a deal. How do you view trade tensions for the next 6 months from an equity investor's perspective?
Well, Niraj, I think you're right to say that the recent news from London is encouraging, although we still have not received any substantive detail of exactly what that entails, at least judging from the latest news that I've read this morning. The operative date, of course, is July 9th, which is the 90-day anniversary or the expiry of the deadline rather of that grace period with regard to rolling back tariffs. And there's a lot of work that needs to be done, not just in terms of the US and China, but obviously with regard to other prominent trade partners. The top 15 trade partners for the US account for about 90% of US imports. So even if you don't have to do deals with over 100 different trading partners, getting 15 deals arranged within 90 days is a tall order of business, given that past evidence would suggest that it takes about 1 to 2 years easily to negotiate just one deal. So I think there still is a lot of uncertainty about exactly where things will land, notwithstanding the fact that there is clearly some positive development or apparently positive development from the U.S. and China talks. So, rolling all that together, I think that the direction of travel seems to be better than it was in early April, particularly between April 2nd and April 9th. But still, there is some degree of uncertainty in the environment in terms of how that exactly will play out.
Tim, very good morning. This is Tamanna here. Good morning from where we are, and pleasure to speak with you as well. Just on the US story and just taking that forward, most indications are that the US economy growth is going to slow down. There's going to be an impact of trade wars that we will see this year on global growth and in some part on India as well. Do you think that that's done and dusted, or will we see this deepen further?
It's a great question. I think that's very much one of the issues that markets are looking at right now. Just to put our numbers on the table, we're looking for U.S. growth to decelerate to 1.0% in the fourth quarter on a year-on-year basis. And that's from a strong run rate in Q2, but that's been upwardly flattered by some volatility in terms of imports, just as the first quarter was downwardly suppressed by kind of a drawing forward of imports, which just arithmetically lowered the growth rate. So the GDP numbers for the first 2 quarters are volatile, and it's hard to get a real grasp in terms of what the forward aspect looks like for growth, but our expectation is that growth will slow. Now, the key debate among market watchers, I'm sure you're well aware of this, is that there's a tension between hard data and soft data. Hard data is held up, soft data really compressed very significantly, which is more the expectations data. That has started to recover as concerns over the trade outlook have moderated. And the question is, where do these indicators meet? We think roughly there will be maybe a 2/3 recovery of the soft data, but still some deceleration in the hard data. And then the question is, to what extent is the market already discounted that and is looking through that? Evidence that our U.S. portfolio strategy team has just published on over last week suggests that the market has probably factored in some of the expected decline in the hard data and is thinking that the soft data will indeed recover. So I think that helps explain a good part of the reason why the U.S. market has recovered, as indeed many other markets have. But one of the key points we're making in our report, just to close my current comment, is that markets have indeed recovered very, very swiftly from their lows in early April 7th for the US, April 9th for many of the other regional markets in Asia. And they're up anywhere between 20 to 23% from that low, which suggests that markets have again become fairly, relaxed about the current environment, which suggests again that they will be that much more sensitive in terms of reacting to incremental news flow that comes out, be it positive or more concerning.
Tim, the other thing that was the most spoken about point, I think, midway through the calendar was, if not de-dollarization, then at least the devaluation of the dollar vis-a-vis a bunch of currencies, DXY coming off, and it has. Now, my question is, I think your report makes a reference to that as well. I would love to know from you if you believe that is the current context as well. Do you believe that will happen over the course of the next 6, 12, 18 months? And does that therefore at the margin mean that an incremental flow of money will move from the West to the emerging markets or Europe or where have you? And do Asia Pacific markets become beneficiaries of that kind of flow?
This is an exceedingly important question, Raj, and I'm glad you asked it. And the simple response is yes, but it needs to be unpacked because there's a number of subtleties to this. So let's get a few key points out into the open. First is that there's a very clear, long-standing relationship between the dollar and Asian equity markets, or more broadly emerging markets, and it's an inverse correlation, namely that when you have a strong dollar environment, you tend to have less favorable Asian or emerging market equity performance, and then when you have a weaker dollar, you tend to have better performance. And significantly, part of the explanation for that, from the work we've done, is that that is intermediated by portfolio flows. So the narrative is that when the dollar is seen to be declining, then people are more encouraged to put their assets into emerging markets, including those in Asia. Now, that's big point number one. Point number two is that we do think that the dollar is in more of a downtrend now. That's a view we've adopted over the past few months. And that really is driven by the fact that we think the dollar is about 15% overvalued on several of the long-term fair value models that we have. And we think we've also got some catalysts for that happening significantly, that the U.S. Current administration has publicly stated they would like the dollar to be weaker. Also, we're seeing relative performance, for example, between the U.S. equity market and other markets, whether it's Europe or parts of Asia or broader EM. Those are now outperforming the U.S., whereas for the last nearly a decade, the U.S. equity market has outperformed, and that's attracted a lot more flows. So you've got a combination of factors now which suggests that you could see some more money flowing into EM. The subtlety, however, here is I think there's an important point that needs to be recognized, which is one around the sequencing of these events. In other words, we think that the longer term stage is set for some more money to flow into Asia, but we think that, first of all, we need to have a moderation of concerns over the global environment, because typically in an environment where risk aversion is high, then money does not flow into emerging markets. It tends to go into safer havens, whether it's other currencies or gold, et cetera. So I think that the narrative here would be first a calming of global uncertainty, hopefully around some better news surrounding trade, and then as risk appetite rebuilds, then we can see some money flowing into Asia. The last thing I'll just say, which is also important, is that does not necessarily mean that investors have to sell their stock of assets in the United States. There's still lots of attractive factors going on with the U.S. equity market, which we agree and are proponents of. But we think at the margin, the flow of incremental monies could go more towards either Europe, which is already some evidence for that happening, or start to recover and come into some of the markets in Asia.
When we're speaking about Asia, Timothy, I wonder how you're looking at India, because, and I get your point, emerging markets is a risky bet if you're risk averse right now from a global investor point of view. But if you're looking for a market, an economy which is relatively padded against global or trade headwinds, would India be a pick there?
So we totally agree with that argument, and many people have been trying to what we call reverse broke me on this. They're sort of saying, "Don't you agree that India has all these great characteristics?" And our response is, we absolutely agree with that. The challenge, as I'm sure you're aware, is that the valuation for India is high. As of yesterday's close on the MSCI India Index, which is a benchmark we follow, but It's pretty much the same for Nifty. The forward multiple is 23.3 times, and that's 1.4 standard deviations above the 10-year mean. So, the challenge here from an investor's perspective is the story is good. And in fact, I think incrementally has gotten better because both the macro data seems to clearly show that the cyclical slowdown, which started in the third and fourth quarter of last year, has run its course, and we actually have been toning up our macro numbers. And similarly, at the earnings level, the downgrades in earnings that we expected, and which in fact resulted in our downgrading our view on the market in early October last year from overweight to market weight, that seems to have run its course. And indeed, we've just toned up our numbers. We're looking for calendar year 2025 at about 12% EPS growth for India, and that's pretty much in line with where the consensus has come down to. So we feel that fundamentally, actually things have stabilized and are turning more constructive. The problem, as I said, is that I think that the market is fairly fully valued, both in absolute terms and relative to other regional comparables. So we've maintained a market weight view with a very sort of constructive underlying narrative. And indeed, there's a lot of themes that we like. We just sort of published on this. I'll just quickly rattle them off. We like the theme of earnings recovery. We like the theme of consumption recovery, financials, the rural and agricultural growth theme, oil marketing companies and tourism, as well as some other broader regional themes, including defense, which was just mentioned on your program before. We like all these themes. So really our message on India is, love the story, think that it's a bit richly valued, therefore you need to be a little bit more focused on picking your spots. And we think there are some spots that you can selectively focus on. So that's kind of where we are. So far, I think it's been a reasonable point of view because the region as a whole is up about 11% year to date. India, whether it's Nifty or the MSCI India Index, are up sort of 5-6% in dollars. So we haven't sort of lost performance by having a market weight view. We're just sort of hoping that there might be a more opportune time to take a more front-footed stance towards our allocation view.
Okay, Tim, you kind of answered a lot of things that we wanted to ask you, but I'll have maybe a couple of questions. So one point that you make that India is fully valued, but except for periods like the COVID meltdown or others, usually India has always traded expensive because of the growth, right? So my question to you is that a pushback that you get when you talk about India with people? Or do people accept that, okay, India will remain expensive, so let's not avoid the market, let's hunt for individual themes which might not be as expensive?
So I would say it's a bit of all that. I mean, it's a well-asked question, and it's one that we engage with investors on a frequent basis.
Exactly.
And I mean, we definitely recognize that better growth deserves a higher valuation. I'm not saying that India should trade where Korea trades, which is 8 times, 9 times earnings. Parenthetically, we like Korea, we just upgraded it, but we can get into that later if you so wish. But the point in India is for sure it deserves and justifies a higher valuation. The question is, how high? And we think that 23 times, relative to expected growth rates, relative to domestic interest rates, variety of dividend discount models and so forth, all that suggests that it's on the sort of the more well-valued side of the spectrum. Now, in terms of our expectations and our forecast for market returns, we're not looking for Nifty to go back to 10 times or 15 times earnings. We're looking for maybe there to be some moderation of valuation to call it roughly 20 times earnings, which is still not a small multiple. So it's not like we're super bearish on the valuation outlook, but just feel that the current one prices a lot of good news in, and maybe doesn't leave quite as much room for what we call beta or aggregate market upside as we would like, or as we see perhaps in some other markets where there's more of a clear argument for valuation expansion. In markets like China, which are overweight, or Korea, where we think there's some catalysts to close that longstanding Korea valuation discount. So we're not. I just want to be clear. We're not negative on India. We very much like it. Totally on board with the longer term growth opportunities, but just feel you need to be maybe a little bit more selective in order to control your entry point and to give yourself a little bit better upside return opportunity.
So we want, what was that term, Timothy? Reverse broke. We won't reverse broke.
Yes.
Yeah, I've never heard it. I'm not sure what it means. Reverse broke. So we won't reverse broke you.
If I could just elaborate on that, it basically means when, I'm sort of the advisor, and then we're generally talking to our institutional investor clients. And so we're the brokers, we're sort of selling ideas to them. And sometimes I find that when I go to conversations, they say, well, don't you think India looks great? Everything you just said before, trying to convince me to change my view and take a more constructive view, basically talking their book to me.
Yeah,
That's what that
loaded
means.
question. Okay, now, so let me ask you about a broader problem, and how grave do you think it is? I'm interested to know your view on this whole rare earth magnet business, with China now suddenly holding this over everyone's head. Here we're reporting makers of electric vehicles in India see only a 30-day supply. It's part of the conversations between US and China delegations. How big of a problem is this going to be?
Well, as you said, it certainly is an important issue. And I think what these trade negotiations have uncovered, not that it was unknown, but it's maybe amplified or shone a spotlight on, that China actually does have negotiating leverage. And it's not just a one-way street in terms of relative competitive advantage with respect to the trade negotiations. I think the U.S. sort of the administration is on record as saying, look, our market is bigger, therefore, effectively, we, the U.S., have an upper hand in terms of trade negotiations, because if you want access to the U.S. Consumer and the large market opportunity, then you need to sort of equilibrate the trading environment. And I think what the current sort of escalation of tensions has revealed is that China has significant operating leverage as well, or negotiating leverage as well. As I said, this is not unknown, and it's not, by the way, just in the availability of rare earth materials, but it's in the refining of them, where China, in some cases, is 100% global market share. And it's hard to ameliorate that in the short term, because particularly in the U.S., if you're going to build a refinery, that takes some time. And on top of that, you've got to deal with a variety of environmental and other local regulatory issues, which may impede the speed with which such a plant could be, or refining activity could be developed. So I think in the near term, there's a choke point which China controls, and that's going to be part of the negotiations. And we'll see exactly how that turns out. But it looks as though what's coming out of the London negotiations between U.S. and China is an effort to sort of dial things back down. But I think in part response to China's control over a globally important resource.
Okay, Timothy Moe, such a pleasure talking to you. And I hope we can do this sooner, maybe around the big festival of Diwali in India. It'll be great to have you again, maybe clad in Indian attire, who knows?
Let's hope. Thank you so much for having me on.
Now, the pleasure was ours.